You're scanning the option chain. One strike is paying almost 3 times what everything around it pays. Best trade you found all month, or the most expensive mistake you're about to make. The wheel strategy answers that in 3 stages, and most traders only ever run one of them. Stage 1 filters the setup itself before premium ever gets looked at. Stage 2 classifies what the premium is telling you, once Stage 1 has already been run. Stage 3 checks whether this trade fits inside everything else you're already holding. Skip any one of the 3, and a trade that looks clean can still go wrong. This is documentation of a process, not financial advice. Quick context before we start. Selling a cash-secured put means agreeing to buy a stock at a set price, called the strike, if it falls there by a certain date. In exchange, you get paid the premium up front for taking that risk. That's the trade we're talking about. Now, Stage 1. Stage 1 is the setup chain. 4 primary checkpoints that decide most of what happens before premium ever gets evaluated. Earnings, structure, trend, ownership. Remember those 4 in that order. That is the chain. Premium is never one of the 4 links. It only gets evaluated after all 4 hold in Stage 2. Break any single link here, and no premium, no matter the size, repairs it. Let's build the chain, 1 link at a time. Checkpoint 1 is earnings. Here's what most traders get wrong about this one. They check whether an earnings date exists somewhere on the calendar, see it's a few weeks away, and move on satisfied. The actual question has 2 parts. Does the report fall inside the option cycle? That's the window between the day you sell the put and the day it expires. Not near it. Inside it. And separately, even if the report sits safely outside that cycle, are you opening this position inside the restricted window right before earnings, roughly the week leading up to the report? That second part catches people constantly, because the position technically expires before the report, but gets opened while the market is already pricing in pre-earnings uncertainty. There's one narrow exception to that restricted window, and it's worth knowing so you don't overcorrect. Inside those 7 days before earnings, a cash-secured put can still be justified if the strike sits far below established support, providing substantially more downside cushion, and the size stays under 1% of the portfolio. That's not a loophole. It's a deliberate, narrow exception, not a general excuse to ignore the window whenever the premium looks tempting. Here's why the underlying rule matters mechanically. Earnings are not a normal trading day with slightly more movement. They're a binary catalyst, a source of discrete gap risk with real money attached. A stock can move double digits overnight, in either direction, and there is no chart pattern, no support level, no moving average that protects you from a gap like that. Think of home insurance on a house sitting in a flood zone. The insurer doesn't pull the policy off the market. They simply charge more because they already know the risk sitting under that house. A rich premium on a strike that covers an earnings report works the same way. The market isn't withdrawing from the trade. It's pricing a risk it has already identified, the same way the insurer prices the flood zone. If this checkpoint alone gets respected, an enormous number of bad wheel entries never happen. But say the earnings date sits safely outside the cycle, and outside that restricted week too. Does that mean the trade is fine? Not yet. There's a second checkpoint, and it's the one that catches traders who did remember to check earnings and felt like they'd already done the hard part. Checkpoint 2 is structure. Is there a real, tested support level sitting beneath the strike you're looking at? That support can take different forms. A moving average, like the SMA 50, a cluster of EMAs, a retested breakout level, or a swing low with genuine history behind it. Not a round number chosen because it's memorable. Not a line drawn the night before because it looked clean on the chart at 11 at night. What matters isn't hitting some fixed number of touches. It's whether that level has actually been defended by buyers under real conditions, not just touched once by chance. Here's the part that should genuinely unsettle you. A premium doesn't usually get rich because the market handed you an inefficiency. It gets rich because the market is pricing more uncertainty or more expected movement, and every option on that entire chain becomes more expensive as a result, including the strikes sitting below what only looks like a floor because it happens to be the most recent low on the chart. This connects to something called implied volatility, or IV. It's the market's estimate of how much a stock is likely to move in either direction over the life of your option. High IV means richer premium for you as the seller. IV rank adds context here. It shows whether the current implied volatility is unusually high or low for that specific stock compared to its own history. It's not the final judge of the setup on its own. It's one more piece of context that sits alongside structure and trend. When IV rank confirms that a spike is genuinely unusual for that stock, and not just elevated in absolute terms, getting paid more for the same strike often means you're being paid extra because more movement is expected, not because you found a better deal. 2 links down. 2 failed, quietly, with nobody raising a hand. But you might still think, fine, the timing on that level was rough, but the broader trend is still up, so how bad could it really be? That brings us to checkpoint 3. Checkpoint 3 is trend, and it's really 4 related checks stacked together, not one. First, has this specific move built any kind of base, meaning a period where price paused and traded sideways, or is it vertical, with nothing beneath it but the momentum that got it there? Think of the difference between a tide and a wave. A tide is slow, broad, and builds momentum over hours. A wave rises and falls quickly, and without the tide underneath it, it has nothing supporting its height. A stock that's run hard for 8 straight sessions without a single pause is a wave with no tide beneath it. Second, how far has price stretched away from its EMA 21 and SMA 50? Once that distance passes roughly 10%, the setup is normally blocked, regardless of how the base looks, unless the strike sits deeply out of the money and position size stays under 2.5%. That's a narrow exception, not a routine way around the block. Third, check ADX. A reading below 20 means the trend itself lacks real strength, and that triggers stricter rules rather than a normal approval, regardless of what the other checks show. Fourth, check momentum on RSI 2-period and stochastic. Readings above 90 on either one are a warning, a sign the move has likely run further than it should have in the short term, even if the broader trend looks perfectly healthy on a higher time frame. None of these 4 checks work alone. Trend strength alone tells you the trend is real, not whether you're arriving at the wrong moment inside it. Distance from EMA 21 and SMA 50 tells you how stretched price already is. Weak ADX tells you the trend itself may not be reliable regardless of shape. Momentum extremes tell you whether the stock is short-term overbought, regardless of what the longer trend looks like. Checkpoint 3 only passes when the base is real, the extension stays inside its threshold, ADX confirms real trend strength, and momentum isn't flashing an overbought warning at the exact moment you're about to sell. Chasing premium into a setup that fails any part of this means that if assignment happens, typically because the stock finishes below your strike at expiration, although equity options can be assigned earlier than that, the shares get put into your account whether you still want them or not, and it happens in close to the worst possible location on the chart, right after the exact move that inflated the premium in the first place. That's not misfortune dressed up as bad timing. That's the mechanical relationship between volatility, premium, and location. And it plays out the same way every time. Nobody checks for it. 4 checks inside 1 checkpoint. 3 checkpoints total, and all of them stacked on top of each other without a sound. At this point, the trade should look obviously wrong. And yet trades exactly like this get taken constantly, by careful, intelligent wheel traders, for years, before the pattern gets noticed. Here's why. The first 3 checkpoints are things you check on a chart, using information sitting right in front of you. The 4th checkpoint is something you have to check about yourself, and that is an entirely different kind of difficult. It's the checkpoint that makes the wheel strategy different from every other way of selling premium. Checkpoint 4 is assignment quality. This is the one that gets skipped the most, and it has nothing to do with intelligence or experience. It requires an honest answer to an uncomfortable question, the kind of question people quietly avoid, because answering it honestly complicates a decision they've already made emotionally. Would you actually want to own this company at this strike, for potentially months, if the market moved against you starting tomorrow? Not could you tolerate it if you absolutely had to. Would you genuinely be fine holding it, checking the price every morning, explaining the position to yourself without flinching? This question isn't about the premium at all. It's about whether you choose to own this company on its own merits, separate from any option attached to it. If your only reason for being willing to own it is the size of the premium, you haven't actually answered the ownership question. You've let the premium answer it for you. This is the question that makes the wheel a wheel, and not just a bet dressed up in options language. Every cash secured put you sell is also, quietly, a decision about what you're willing to own. If the honest answer is no, the size of the premium sitting on the table becomes completely irrelevant. There is no trade. It does not matter what the number says, how attractive it looks, how much better it is than everything else on that chain. A great premium on a stock you don't actually want to own is not a great wheel entry. It's a bad trade wearing a good number. And this is the hardest checkpoint to fail, honestly. Because failing it means admitting the premium talked you into something you wouldn't have chosen on its own. That's stage 1 complete. Earnings, structure, trend, ownership. 4 checkpoints that catch most of what goes wrong before premium ever enters the decision. Here's the idea underneath all 4. Selling a put is basically acting like an insurance company. You get paid for accepting a risk, whether or not that risk ever actually shows up. A good premium is not a signal. It's a question the market is asking you: how much risk are you willing to accept? Most traders never actually answer that question. They just take the money and assume the question answered itself. Run the 4 checkpoints, and you're forced to answer it before the money ever changes hands. Here's what running stage 1 looks like in practice, compressed into something you can actually do on a live chain, instead of just recognizing after the fact. Open the chain. Before sorting by yield, sort by expiration, and scan for the earnings date and the restricted pre-earnings window first. 1. Look at the calendar. Checkpoint 1 done. Then look at the chart itself, not the option data. Check whether the strike sits beneath a level that's genuinely been defended, whatever form that support takes. That's checkpoint 2. Then check the base, the extension from EMA 21 and SMA 50 ADX and Momentum on RSI 2 period and stochastic. Checkpoint 3 is a full picture, not a single number. And only then, with the premium still hidden from your attention as much as possible, ask the ownership question honestly. That's checkpoint 4, done before you ever look at what the strike actually pays. Stage 1 filters the setup. It doesn't touch the premium at all. That's stage 2. Stage 2 classifies what the premium is telling you, once stage 1 has already been run. Fair and elevated are the 2 tiers that apply to a setup that actually passed all 4 checkpoints. Risk-driven is the classification that gets attached to a setup stage 1 already rejected, and it tells you exactly why the number in front of you doesn't mean what it looks like. What none of the 3 tiers do is override your position sizing, which belongs to stage 3. A tier can only ever pull size down further within your existing portfolio limits. It never expands a trade beyond what your portfolio rules already allow. Tier 1 is fair premium. All 4 checkpoints pass with real margin. Earnings comfortably outside the cycle and outside the restricted window. Support that's held up under real varied conditions, whether that's a moving average, a cluster of EMAs, a retested breakout level, or a swing low with genuine history, defended more than once rather than simply touched once by chance. A base that took real time to form. Extension, ADX, and Momentum, all inside acceptable range. And an honest yes on ownership that exists independently of the number. When a premium sits in this tier, it typically won't be the richest number on the chain. It'll look almost unremarkable next to the strikes around it. That's the signature of a clean wheel entry. Boring, and exactly what you want. This is the tier where the setup becomes eligible for normal sizing, subject to stage 3, because the risk has already been evaluated and accepted before the premium ever entered the decision. Tier 2 is elevated premium. The 4 checkpoints pass, but at least one of them passes narrowly. Support that's real but thinner than you'd like. A level with some history behind it, but not yet the kind of repeated, varied confirmation that makes it feel fully proven. A base that formed, but briefly, or extension, ADX, and Momentum sitting close to their limits without breaching them outright. This tier isn't automatically a rejection. It's a signal to demand one additional piece of confirmation before acting. A quiet session where price sits near the level without urgency, or a second candle after a bounce that doesn't immediately reverse. Elevated premium earns patience, not automatic trust, and not automatic rejection. And when a Tier 2 setup does get taken, size it below what a Tier 1 setup would get, inside whatever ceiling your portfolio limits already impose. The tier reduces size further. It never becomes an argument for pushing size upward. Tier 3 is risk-driven premium. The label for a setup stage 1 has already rejected. 1 or more checkpoints failed outright, and the premium is large specifically because of that failure. No amount of confirmation rescues a Tier 3 setup, and no position sizing rule makes it acceptable either. The rule here is simple and non-negotiable. Reject. Regardless of the number, regardless of how it compares to everything else, on the chain that day. 3 tiers: fair, elevated, risk-driven. That's stage 2 complete. It tells you how much to trust the premium and how much confirmation to demand. It never tells you how much of your portfolio to risk. That decision belongs entirely to stage 3. Before we get to stage 3, it's worth seeing how stage 1 quietly breaks even for traders who already know all 4 checkpoints and think they're past this mistake. The first way is a support level that technically held, but shouldn't have counted. A level gets tested once, holds, and gets marked as structure. Then a second test happens, but this time it's driven by a scheduled catalyst, a sector-wide news event, a broad market sell-off, not by the stock's own supply and demand. A level that bounced during a broad market sell-off bounced because everything bounced that day, not because buyers specifically defended that stock at that price. Counting that as a second real test confuses a market-wide event with stock-specific behavior. It's one test, not 2, regardless of how the chart looks afterward. The second way is the honest question answered dishonestly. This is the most common failure among wheel traders who've already learned the lesson once. They ask themselves the ownership question: would I actually want to hold this? And they answer yes. But the yes only shows up after they've already seen the premium. The failure here is sequencing. Answering the ownership question after the premium is already visible isn't running checkpoint 4. It's writing a justification backward from a decision your emotions already made. The only way to test this honestly is to ask the ownership question with the premium hidden or ignored before opening the chain and see if the answer holds. The third way is rolling. That means closing your current put and immediately selling a new one, further out in time, usually for an extra credit. A cash-secured put fails one of the first 3 checkpoints after the fact. The earnings report surprises everyone. The support level breaks. The trend reverses hard. Instead of accepting the loss and rejecting the position gets rolled forward for that additional credit, and the credit gets treated as proof the trade is still fine. Rolling doesn't repair a broken checkpoint. It only postpones the moment you admit the checkpoint broke, and it charges you a credit for that postponement that looks like progress, but isn't. That's how stage 1 breaks silently. Now, here's stage 3. And it's the stage most traders skip entirely, because everything up to this point already felt like enough work. Stage 3 checks whether this specific trade fits inside everything else you're already holding. 5 separate cash-secured puts can each individually pass all 4 setup checkpoints and land in Tier 1. But all 5 might happen to sit in the same sector, exposed to the same catalyst, moving on the same macro news. 5 individually clean trades sitting in the same sector don't remain 5 independent risks. If the sector gaps down together, all 5 move together, and the position behaves like one large concentrated bet wearing 5 different ticker symbols, even though each one passed its own checkpoints independently. Stage 3 also covers boundaries that exist regardless of how good any single setup looks, and microcap names get their own override gate here. Below roughly 500 million in market cap, or with ADX already below 20, approval requires a strike at least 10% out of the money, position size under 1%, no earnings inside the next 14 days, and a support or bounce zone that's actually clear on the chart. Miss any one of those, and the name gets rejected regardless of how attractive the setup looks otherwise. Beyond microcaps, position size stays within your normal portfolio limits, tighter again for anything already correlated to positions you're holding. Cash reserve stays available rather than fully deployed, because stage 1 and 2 only ever evaluate the trade in front of you. They were never designed to evaluate the portfolio as a whole. That's what stage 3 exists to do, and it has to be run separately every time after stages 1 and 2 are already finished. None of this feels satisfying while it's happening. Rejecting a rich premium because one checkpoint failed doesn't feel like winning. It feels like watching a number walk away from you. But the wheel strategy was never built to reward the excitement of any single trade. It's built to reward what happens across dozens of cash-secured puts and covered calls, evaluated the same way every single time. The trader who rejects 3 tempting setups in a row and takes the 4th one that actually holds up isn't behind. They're exactly where the process is supposed to put them, holding fewer positions, but positions they can actually explain, defend, and hold through volatility. There's one more place, a version of stage 1's trap waits, on the other half of the wheel. Once you're assigned and holding shares, you sell covered calls against that position. That's the mirror image of a cash-secured put. Instead of agreeing to buy shares at a strike, you're agreeing to sell the shares you already own at a strike, in exchange for premium collected today. The rule here has more nuance than a single line. A covered call strike above your assignment price is preferred, because it preserves some capital gain on the shares themselves on top of the premium. A strike at your assignment price is defensible. You are not locking in a loss, but there's no cushion left from the stock itself, only the premium. A strike sitting between your assignment price and your effective cost basis, meaning the assignment price minus every premium already collected on this position, is a deliberate choice to accept a smaller overall profit in exchange for releasing capital sooner. That can be a reasonable decision, as long as the full cycle still comes out ahead. A strike below your effective cost basis is off the table. That's the one line that doesn't move. Selling there locks in a real loss on the position, no matter how attractive the premium looks. The danger on the put side was owning something you didn't actually want. The danger on the call side is treating a rich premium on any strike as automatically fine, just because it's a covered call, without checking exactly where it sits, relative to your assignment price and your effective cost basis first. And risk doesn't stay isolated politely, waiting its turn. It compounds. Picture a setup carrying two of these problems at once. Implied volatility elevated well beyond its normal range, sitting on a strike with no real tested support beneath it. That's not simply twice as risky as either problem alone. Two separate signals of elevated risk sitting on the same trade compound each other, amplifying the danger beyond what either one would create by itself. Weak structure means nothing stops price if it starts falling. Elevated volatility means the market already expects a large move. Put those together, and a single bad session can travel straight through a level that was never going to hold anyway. Add a third condition, an earnings date sitting close enough to the expiration that positioning ahead of it has already started distorting the entire chain, and the conditions don't stay separate anymore. They compound, each one making the others more dangerous, even without a precise formula for exactly how much. No premium offsets, multiple structural weaknesses stacked on top of each other. Here's the mindset shift underneath everything in this video. 3 stages. Stage 1 filters the setup, earnings, structure, trend, ownership, before premium ever gets a vote. Stage 2 classifies the premium into fair, elevated, or risk-driven once the setup already passed or already failed. Stage 3 checks whether this trade fits inside everything else you're already holding. Sizing, cash reserve, correlation, microcap boundaries. Skip Stage 1, and you're chasing risk you never evaluated. Skip Stage 2, and you're sizing a trade you haven't actually classified. Skip Stage 3, and 5 individually good decisions can quietly become one bad one. So go back to that strike sitting on your screen right now, paying almost 3 times what everything around it pays. Is this the best cash secured put you've found all month? Run Stage 1, classify it in Stage 2, check Stage 3, and you'll already know the answer before you finish reading the option chain. That's not a shortcut around the wheel strategy. That's what running it actually looks like. Structure before premium. Assignment before premium. Risk before return. The market decides the outcome. You decide the process. Back to execution.